We're looking at NASDAQ ASST, Strive Inc., and just before the opening bell, the stock is indicating a move up. In pre-market trading, we are seeing a price of $1.35 per share, which is a pop of about 1.5% over last Friday's close of $1.33. Now, for a stock this volatile, a 1 or 2% pre-market move is just noise. That is what most investors would think. They would see this tiny green candle and dismiss it as random fluctuation in a low-float, highly speculative name. But the reality is, what is happening with Strive this morning is anything but random. The expectation that this is just another volatile day for a forgotten small cap is completely wrong. The reality is that just hours ago, Strive Inc. announced a major, complex, and frankly wild strategic capital raise that completely reframes the entire investment thesis for this company, and it directly involves Bitcoin. Most investors who are still holding shares of ASST probably got in during the hype of the last few months. They likely remember the name Asset Entities and the merger that completed in September, rebranding the company to Strive. The general belief is that this is an asset management company, one that runs ETFs and has a particular viewpoint on shareholder engagement, and that it is trying to find its footing after a brutal pullback from its 52-week high of over $13. The stock has been a nightmare for long-term holders, with articles as recent as mid-October highlighting a catastrophic 84% drop in just a 30-day period. The sentiment on forums like Reddit is a mix of frustration and bag holding, with many retail traders posting about getting burned after believing hype that $2 was a certainty. But here is the critical piece of reality that the market is just now waking up to. Strive is not just an asset management company. It has explicitly rebranded itself as the first publicly traded asset management Bitcoin treasury company. This is not a side hustle. It is their core identity. Their stated strategy is to use their corporate treasury to build a war chest of Bitcoin, with the goal of increasing the amount of Bitcoin per share over time. As of last week, they already hold nearly 6,000 Bitcoins. This company is a leveraged play on a digital asset wrapped in a corporate structure. And the news that dropped today proves they are doubling down. Strive announced a proposed initial public offering, not of common stock, but of a brand new class of shares, variable rate Series A perpetual preferred stock, which they are calling SATA stock. They plan to offer 1.25 million of these new shares at a price of $100 each. The bombshell is the dividend. This new SATA stock is designed to pay an initial annual dividend of 12%, paid out in cash monthly. And what are they going to use this new capital for? The press release is clear. Among other things, the acquisition of Bitcoin and Bitcoin-related products. This changes everything. Strive is tapping the public markets with a high-yield debt-like instrument to raise capital specifically to buy more Bitcoin. This is an incredibly aggressive, high-stakes financial maneuver. On one hand, if the price of Bitcoin appreciates significantly, Strive's treasury will swell, and this leverage will look like a brilliant move. They will be using capital that costs them 12% a year to buy an asset they believe will return far more. But on the other hand, this creates an immense and immediate cash burden on the company. A 12% dividend on a potential $125 million raise is a massive recurring cash expense. Investors must ask, where will that cash come from? Will the profits from their $2 billion asset management arm be enough to service this new preferred stock? Or, in a down market, would Strive be forced to sell its Bitcoin holdings just to pay the dividends? This move is a direct challenge to the market's expectation. This is not a company trying to stabilize. This is a company taking on significant leverage to make a concentrated bet. And this brings us directly to the other side of the trade, the short sellers. The tension in ASST is not just between bulls and bears. It is extreme. Recent data shows the short percent of the float at a staggering 38%. That means for every 10 shares available to trade, nearly 4 are held by investors betting the price will go down. This is an incredibly high conviction short position. Back in September, there were reports of the short interest being even higher, potentially over 100% of the float, which led to a lot of discussion about a potential short squeeze. That short squeeze never fully materialized, and the stock collapsed, rewarding the short sellers. But with 38% short interest today, the situation remains explosive. What is the short thesis? It's probably that Strive's dual-pronged strategy is unsustainable. The shorts are betting that the asset management business cannot support the company's operational costs and this new massive 12% dividend on the SATA stock. They are betting that the company's fate is tied to Bitcoin and that any dip in the crypto market will crush ASST's balance sheet. They may also be looking at the recent insider trading activity. Filings from the last 6 months show 0 insider purchases, but 3 significant sales, including from the executive chairman and the chief financial officer. When executives sell stock, it's often seen as a bearish signal, a lack of faith in the near-term future. So, here is a direct question for everyone watching. What is your take on the 38% short interest? Is this a smart bet against the company's Bitcoin strategy, or is it just fuel for a future squeeze? For investors who are trying to navigate this, it's crucial to understand how to track this information. You can find short interest data on financial platforms like Fintel, Ortex, or directly from NASDAQ. You're looking for the short percent of float. Anything over 20% is considered very high. You also want to look at the borrow fee rate. This is the interest rate short sellers have to pay to borrow the stock to sell it short. If that rate spikes, it means shares are scarce and it's becoming expensive to bet against the company. Another more advanced metric is fails to deliver, or FTDs. You can find this data directly from the SEC. When a short seller fails to deliver the shares they sold, it shows up in this data. A high number of FTDs can indicate stress on the short sellers and is a classic signal that squeeze watchers look for. But a word of caution, playing short squeezes is not investing. It's high-risk gambling. The short sellers in ASST were right for the last 2 months as the stock fell from its highs. So, let's step back and look at the company that Strive Inc. has become. It's really 2 businesses under one roof. First, you have the legacy asset management business, which Strive's founders built on a specific philosophy of shareholder engagement, managing over $2 billion in assets across ETFs and other products. This business generates fees. Second, you have the new corporate identity, the Bitcoin treasury. This side of the business functions more like a holding company, using its cash and, as of today, raising new capital to acquire and hold Bitcoin. This entire corporate structure is the result of a flurry of recent activity. The merger with asset entities only closed on September 12th. Just 4 days later, they announced the acquisition of another company. Then on September 22nd, they announced another all-stock merger, this time with Semler Scientific, to further their Bitcoin treasury goals. In early October, they appointed a new chief investment officer specifically to advance this Bitcoin strategy. And now today, the high-yield preferred stock offering. This is a company in a state of extreme and rapid transformation. Looking forward, the picture is one of binary outcomes. The bull case is clear. Strive has created a unique publicly traded vehicle for Bitcoin exposure. By raising capital through this new SATA stock, they are effectively borrowing at 12% to buy an asset they believe will be a world-class performer. If they are right and Bitcoin's price rises significantly, the common stock of ASST could appreciate dramatically as it represents a leveraged claim on that growing treasury. The new 12% dividend stock itself may also be attractive to income investors, though it carries its own set of risks. The bear case is just as clear. This is a house of cards. The company is taking on a massive fixed cash dividend obligation. This move could be seen as an act of desperation, a way to raise capital when other avenues are closed. If the asset management business falters, or if the price of Bitcoin stagnates or falls, Strive could find itself in a cash crunch, unable to pay its new preferred dividend and forced to dilute shareholders or sell its Bitcoin holdings at a loss. The insider selling adds significant weight to this bear case. The risk is not just that the stock will go down, it's that the entire complex financial structure could fail. The expectation was a small-cap stock. The reality is a highly leveraged, speculative, and complex financial vehicle that is tying its fate to the future of Bitcoin, funded by a high-yield preferred stock. Comment below with your thoughts on this new SATA stock. Is a 12% dividend to buy Bitcoin a genius move or a sign of desperation? As we head into the trading session, the key thing to watch is the volume. That pre-market pop to 1.35 is small, but it's a reaction to this major news. The question is whether the market will interpret this news as bullish, a smart way to acquire more Bitcoin, or bearish, a risky, expensive cash burn. Will the bulls try to fight the 38% short interest, or will the short sellers see this new dividend obligation as the final nail in the coffin and increase their positions? The battle between the expectation of a simple asset manager and the reality of a leveraged Bitcoin treasury is about to play out, and it will be anything but interesting.